Hello investors and traders, welcome back to the Trend Trader channel. But today we're just gonna off ramp a bit and not talk about trading. So today I want us to talk about ETFs that you can invest in so that you grow your wealth, right? So we are talking ETFs. We are not talking trading stocks, all those kinds of things that we normally talk about in this channel. Also, we are not talking about technical analysis or fundamental analysis. We are just looking at product that can help us to create wealth for us, wealth that we can pass to the next generation, right? So what sparked this conversation? It's a follow-up on the video that we had yesterday where we were asking if it's possible to beat the stock market, right? So now, like I said yesterday, it's possible to beat the stock market, but that video kept on dragging or going on and on and on. So today I want to discuss a solid, concrete approach that you can use to build wealth, wealth that you can build for yourself and that you can pass to the next generation. It could be your kids, it could be whoever that you want to live with, the wealth that you will have created using this approach. Okay, so today we remove our trading technical analysis hats, we put on our investors hat. Today we are going to think and act like investors, right? So now there are so many products that you can use to build wealth. You can invest. By investing, we simply mean taking your money, using your money to generate more money, right? So you're using one resource to generate plenty of that resource. So we're talking about money, and we want to do that in the stock market. You can invest in a business outside the stock market. It doesn't matter what kind of a business that you invested in outside the stock market. You could be property investing, you could be farming, you could be owning spaza shops, but you can have a business. But we're not talking in the context of such businesses. We are talking in the stock market. So the simple vehicles that are available at our disposal that you can use to build wealth in the stock market. Anyone can do it. It doesn't matter your level of knowledge when it comes to understanding the market or understanding investing, right? The simplest way to build wealth in the market is to invest in ETFs. This is not the first time you are hearing this conversation, and definitely not the last time you are hearing this conversation. It's the conventional wisdom. Everybody knows it, that if you want to build wealth in the stock market, you invest in low-cost index tracking passively managed funds. Right, back in the day, people used to invest in mutual funds. We no longer, well, there's mutual funds still exist, and maybe ETFs are still mutual funds. But what was defined as mutual funds then differs from what we know as ETFs today. For example, back in the day, you could invest in unit trust. So investors will pull money, then the fund manager will invest that money on behalf of the investors. Again, those some of the mutual funds, they could track the index, like tracking the top 40. Some of the mutual funds, it could be a mixture of equities, property, bonds, etc., to make maybe what is called a balanced fund, or maybe it's an income fund. So nowadays, when you talk of mutual funds, we mostly refer to exchange traded funds, ETFs. A lot of people have described ETFs, the benefits of ETFs. One of the benefits is that ETFs are highly liquid compared to mutual funds such as unit trust. And since they are listed on the public market, they can easily be traded during the day, so the net asset value can change during the day. Unlike a unit trust where the market has to close, then they have to calculate the investment to determine the net asset value. The mutual fund, the ETFs, the value is just any time of the day you will know how much that ETF cost, right? So now you only need, as a South African, maybe it differs if you are in other parts of the world, but as a South African, you can just use 2 ETFs to build wealth. Not many, just 2, right? Another thing that I want to touch in, it doesn't matter whether you buy these ETFs in the tax-free savings account, which will be beneficial because you will be reducing your tax liability. So your money will be working even much faster because you will be tax exempt for investing in a tax-free savings account. But also, you can still, once you've maxed out your TFSA, if you want to, you can invest whatever amount of money that remains outside the TFSA, but you still buy the same ETFs, because with the TFSA, you're only limited at the current tax year, 2021 going to 2022. We are limited to 36,000 rand per annum on a tax-free savings account, right? But you want to invest each and every month. If you have a steady income, maybe it will differ from person to person, but we are talking from a working or middle class perspective. You earn a salary, a stable income each and every month, then you know that it's possible that you can invest more than 36,000. So you don't want to invest 36,000 and be out of the market because you're waiting for the following tax year. So you can max out your tax-free savings account and then invest in the same ETFs outside the tax-free savings account. The difference now is that outside the tax-free savings account, you will be paying tax there, like dividend withholding tax or distribution tax. Depends on how that tax is classified, right? So the first ETF that you can invest in as a South African is an ETF that is tracking the JSE Top 40, because the JSE Top 40, that's our general market in South Africa. Yes, the overall market is called an all-share index. That includes all the 300 plus companies that are listed in the JSE. So the JSE is the Johannesburg Security Exchange. We know that we also have other exchange. I think now there's a Cape Town Stock Exchange. Also there's that alternative exchange. I think it's called ALTX or A2 something. But yeah, we are speaking in the context of JSE. You can invest in a top 40 index tracking ETF. There's plenty of them that comes from different ETF insurers. But now the catch is on total expense ratio. You want to buy the cheapest top 40 index tracking ETF. And the cheapest at the moment is the Satrix 40. It has a total expense ratio of 0.1%. So that at the moment is currently the cheapest. You can still buy some, let's say maybe cautious or new funds or one vest, but the cheapest in terms of total expense ratio, it's Satrix Top 40, right? So that's the ETF that you are going to buy to track the JSE market. Then the other ETF that you should buy is an S&P 500 or a US market tracking ETF, right? So in the US market, we have the S&P 500, which tracks the 500 largest companies in the New York Security Exchange, but also there's a Russell 2000, which tracks the small caps. And then there's Nasdaq 100, which tracks the 100 non-financial stocks in the Nasdaq. Mostly of those stocks are tech stocks. So we want the general market, not a specific sector. We're not targeting a specific sector. We just want to track the general market. So the ETF that you should buy there, it's an ETF that is tracking the S&P 500, right? Even there, you are still spoiled for choice. There are a lot of ETFs that you can buy. So if you want to buy that ETF in a tax-free savings account, assuming your Easy Equities tax-free savings account, you are going to buy Signia Etrix S&P 500 ETF. There are other ETF insurers that are tracking the S&P 500, but why the Signia differs, right? Signia and all the other South African fund managers don't offer. They are tracking an underlying ETF or fund that is tracking the S&P 500. And some of them, they use, I think it's a Charles Schwab S&P 500 ETF. That ETF does not distribute. As a result, there's ETF issuers here in South Africa. They also do not distribute. Like for example, OneVest S&P 500 feeder fund or something. Yeah, it's a very long name. That fund does not distribute. Yes, you'll still get the returns of the S&P 500, but without any distributions. So the Signia Etrix S&P 500 ETF, it does distribute. I believe that it tracks a fund that distributes, but the Signia S&P 500, it distributes biannual. You will get some distributions in June, and also will get some distributions in December. Well, maybe the distributions are paid in July and January, but every 6 months you are going to get distributions. So those are the two ETFs that you can buy and hold. Now, how long should you hold these things? I'm not a believer of buy and hold, but as long as you are invested in the market, there is no need for you to get in and out of those ETFs. You can just buy them, hold them. Every time you get income, keep on topping them up, keep on topping them up. Just keep, I mean, some people, they do love this rent cost averaging. You buy, it doesn't matter whether the market is rising or the market is falling. They just keep on investing. Every time they just add in money. Then the performance is going to differ. Some years we are in a bullish market, some years the market is flat, and some years, unfortunately, they are bearish. But you're just going to keep on investing there, putting in money so that you grow your contributions, you grow your capital base. Eventually, the compound interest is also going to start to have a major effect in your portfolio, because as the fund grows, let's say for example per year you return an average of 15% either on the JSE or Satrix top 40 ETF or on the Signia S&P 500 ETF, you are just returning 15% on average. After a while, the value of your contribution is going to double just from the capital appreciation plus also the reinvestment of the dividend. Remember, we are not trading, we are not looking for money that we can withdraw every now and then. We are just contributing and letting the market to grow our wealth for us. Our job is to continue with our day-to-day jobs, receive an income, take that income, subtract whatever percentage that we've decided that we want to invest this much. We take that percentage, we throw it in the market, then we allow the market to do its magic. Right? Now, what are the benefits of investing in index tracking ETFs? You know, when you ask around, what do you think of Sasol? Everybody will have an opinion on Sasol or Advtech, whichever company. But with an ETF, you don't need to crack your head with that challenging, do your own research thing. It's simple. It's the ETFs are already diversified. Top 40, it tracks the top 40 largest companies in South Africa. Different sectors, different performance. Some companies are doing great, some are not doing great. The S&P 500, it tracks 500 companies. Well, if you buy the Vanguard S&P 500 ETF, it's actually 506 companies rather than 500 companies. So it's already diversified. 500 companies, different sectors. You've got techs, you've got consumer staples, there's resources stocks in there, there's real estate. So you don't have to worry about diversifying. 3, it's easy to manage. You are just looking at 2 ETFs, you know, S&P 500, Satrix Food. You can even automate on Easy Equities. You can activate a debit order each and every month. Easy Equities will take a portion of your money from your bank card or from your bank account, put it in your Easy Equities account, then trigger a trade there, buy the ETFs on your behalf. So it's something that is very simple that you can do easily. And you just let it keep on going on like that, making that debit order and allow it to grow. Let me dismiss this alarm. Okay, yeah. So it's easy. You can just set up a quick debit order with Easy Equities, and then you tell Easy Equities to invest that money in those two ETFs. You don't have to worry about doing research. That thing is already diversified. The Satrix Top 40, it has 4 distributions, quarterly distributions, March, June, September, December. They declare some distributions. They distribute money. Remember, we are investing. We don't want to chow that money. We reinvest that money. Rinse, repeat. That is how you grow wealth easily. 2 ETFs, Satrix Top 40 and Signa Etrix S&P 500. Why should you complicate it? It shouldn't be complicated, you see. So at least today I gave you something that is less complicated. Not technical analysis, not trading. You don't have to worry about charting. You just have to open your Easy Equities account, put in money there, buy these ETFs. The best case scenario is to buy these ETFs in your tax-free savings account so that you don't pay those 20% dividend withholding tax. But remember, you can max out the TFSA. So once your TFSA is maxed, then you can go and put your capital in that normal South African rand ETF. But my preference, I have the Satrix S&P 500 ETF, but I prefer to invest in the USD account. So there I buy the Vanguard S&P 500 ETF, same TER, 0.1%. It is denominated in US dollars. So as the S&P 500 index grows, also that ETF, it grows. But remember, sometimes the US dollar rand exchange rate can be a bit iffy. Sometimes our rand is losing a lot, so I also benefit from that. So once I've put enough money in my tax-free savings account, I take a portion of that money, then I put it in the US dollar account and buy the Vanguard S&P 500 ETF. I mean, most if you watch American YouTube channels, they will be talking about the Vanguard ETF, but there's another one called the SPDR. We just say it's a spider, SPY ETF, that does the same thing. It tracks the S&P 500. The difference between the SPY and the Vanguard, again, both of them are cheap. It's just one is offered by Vanguard and the other one is offered by Charles Schwab or SPDR, something like that. So that's what I wanted to share with you today. And then one last thing that I want to warn you about. This is the most boring way to make money. Because remember, when we talk about other companies, individual companies, there's that thrill. Oh, Avenge is doing this, Bell is doing this, Capitec is doing this. There's always that thrill. Here, there's no thrill. It's just boring index, but it's efficient. We're not talking about beating the market. We're just talking about the most efficient, cheapest way to build wealth. That is via the ETFs. So that's it. I'm just going to repeat here before I just ramble. I have a tendency to just talk. So if you enjoyed this video, please consider subscribing and liking this video and share it with as many people as you can so that we can help each other to build wealth for ourselves so that we can retire comfortably and also so that we can pass our wealth to the next generation. Thank you. I will see you in the next video.